Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, Brian is going to show us how to read your annuity statement. Now,
Woohoo!
right? Best video of the year. In all seriousness, we've done a few how to read your statement videos. And while they might not seem like the top of your, priority list or the sexiest topic in the world, it is imperative you understand what's in these statements because it's your money.
Yes.
You're paying the fees. You need to understand the contract guidelines. You have to, especially with annuities, because you want to make a move or something happens and you may be locked in a specific way and it's going to cost you. So we're going to learn how to read an annuity statement today.
Yeah, it's funny, Michelle. Over my 24 years as a financial advisor, consumers have a hard time reading any type of statement, okay? And it's not their fault. These statements should be made to where they're self-explanatory for anybody to read, right? And, not only have a hard time reading them, they have a hard time understanding them. So many times I get this phone call that says, hey, Brian, I got this statement in the mail. What does it mean?
What does it mean? No, I get it. Yeah, they don't make it.
That's what we're going to break down an indexed annuity statement in greater detail today. So.
All right. So Brian, you want to pull up our screen so we can look at that example indexed annuity statement.
Yes.
And in the meantime, while he's doing that, if you like the content of this video, make sure to hit that like button, help us grow this channel. And also do not forget to subscribe because we put a lot of videos out, not just on statement reading. We do a lot more than that, but, really show you how to stop being a transaction and instead become an informed consumer with a brighter financial future. All right, Brian, the floor is yours.
Okay. So what I have here on the screen is an indexed annuity statement from this company, Equitrust Life. Okay. So on the left-hand side, we'll read from left to right, just like you normally read a book, right? In this one here, we've got the Dynamarc Indexed Annuity. So it states what type of annuity it actually is. Okay. And this is our annual statement. And you'll see, Michelle, the annual statement, and which is what you're going to see with most indexed annuities, they only come out once a year.
Once a year,
so this statement went from November 14th of 2020 to November 14th of 2021. They said one of the big questions I get from consumers that have annuities is, why don't anybody ever contact me? Right. Well, they do once a year. Yeah. It's that simple. Right. So also on the right-hand side, we have the company's name and all their contact information. Here's why this is important. Look, you need to know who you're doing business with. And, as a financial advisor, I get all the compliance bulletins from the state regulators saying that, oh my gosh, we stopped this company out there because they were out there selling annuities or selling fake annuities and making their own statements and giving them to consumers. We're talking hundreds of millions of dollars a year are lost because of that. Okay. So when you get your statement, you got questions, pick up the phone and call these guys. Verify that, look, your agent may be your best friend forever, right? But this is still your money. Pick up the phone and call the company and verify everything that you've got in front of you in this statement. So, and it
comes once a year. You can do this once a year.
Yeah, do it once a year. So it's funny because I've taught our clients how to do that, Michelle. And all of a sudden I get a phone call from an insurance company and say, hey, Mom and Pop Smith over here called and just to make sure your statement. And I said, can I tell them to? Right. Okay, Brian, please let us know next time because we get lots of phone calls for your clients. I said, well, that's what they're supposed to do. So
exactly. All right, so let's go to the next section.
Next section, you'll see contract all the time and a contract number and a contract effective date. So with most annuities, Michelle, they're written on a contract. So you have to know the date when it started and your account number. So you look at contract number as your account number. It'll also list like owner, joint owner, annuitant, and what type of plan it is. Like in this specific case, this is an IRA account. Right. So if you had a cash account, you wouldn't see IRA here. It'd just be a standard annuity. Also in this.
Oh, sorry. Real quick, what's an annuitant?
Annuitant is what the annuity is based upon, the life expectancy of that person. Okay, sometimes it's the owner, sometimes it's a different person. So it just depends on how the contract is written.
Okay, got it. Thank you.
Also, in this section, you may see a section that talks about beneficiaries. We've talked about that in some of our other statements.
Sure.
Make sure your beneficiaries are up to date.
Yes.
Also, beside it, you not only the contact information that we've talked about up above of the company, you'll see the contact information of your advisor. So here's a key point. If the agent is the same as the insurance company, that usually means your agent's no longer in business. So remember that. Your agent will be listed on any of these statements. If they're not there and it says home office account or the name of the insurance company there, your agent's already out of the business.
Okay.
So it's very common. Next section we look for, Michelle, is a value section. Here's your values. This is your showing where your account was. Like, look here, 11 of 2020, the account value was $148,663. 11 of 21, the account value is $157,000. Just rough calculation, that's a $9,000 gain over the last 12 months, right?
Right.
Not a bad return.
No, not at all.
6.5%. So, but look at the difference here. See the surrender charge?
Yes.
The surrender charge last year was only $614. This year it's $8,667.
This means if you surrender that contract, if you surrender the contract on 11/14/2021, you're only getting $8,667.
Well, no, that's your actual surrender charge. That will be subtracted from it. But
that's what's subtracted from it. Okay, so it's not the actual. All right.
But look at this here. We actually had a market value adjustment, $9,000 last year, $8,578 this year. That offsets your surrender charge. So your accumulation value is $157,598. Your cash surrender value is what you always want to look for is $157,508. That's only a $90 difference.
Got it.
Okay. You might have 7 more years of this contract, but for $90, you could walk away from it today.
Got it. Okay. All right. So I'm going to back this up just because clearly I'm so glad we're doing this. So the surrender charge is what it's the fee that it would cost you to actually surrender.
Walk away and surrender your annuity.
Like 11/14/2021 is going to cost you $8,667.90.
Right.
But because of the market value adjustment for that year, it offsets it. So
it offsets it.
$90 to walk away. And now it's not
I
always
love seeing statements that come out like this.
But it's not always that pretty, is it?
No, it's not. But when you do see that and you see a positive gain to your consumer. So, Michelle, I seen one the other day. It was up $32,000 for the market value adjustment because the interest rates worked against the insurance company. So my consumer not only got their interest at the accumulation for the year, they also got an additional $32,000 if they walked away. It's a big decision to be made there. So
got it. Okay.
And then you'll also see a death benefit in the same section. So if you died today, what are you going to get? It's always going to be, for most accounts, it's going to be the accumulation value. Okay. Now, go to the next section. It's going to be values by the account. I don't know why they put account there. To me, it's based on what it's deposited in. So like over here on the left-hand side, you'll see your different allocations. So your fixed account. So this client had $36,462 in the fixed account. And then down below, they had the indexed accounts. Okay. We talked about these before. This is where the ones track like the S&P 500 and you get returns based on the index. Well, they had in the 1 year point to point, they had 78,000 and the 1 year monthly cap, they had 34,000 and change. As you scroll across the page, you'll see, I go to this section here. This is what everyone wants to look at. How much money did I make? The fixed account paid them $948 for what was in there for the year. The 1 year point to point paid $3,907 and the 1 year monthly cap paid $4,079. So for the grand total, they gained $8,935 for the year. Pretty exciting. So. Next section. Any transactions. This is, and you see there's none on this page, okay? This is where, let's say you took out a free withdrawal from your account during the year, you took out RMDs, anything that was out of the ordinary during that time frame would be listed here. What type of transaction it was, what the tax year was because of tax purposes, right? Any charges, any bonus that was surrendered, anything like that would be listed here. So
got it.
Also on this, and make sure you go back and watch this section of the video, folks, because we talked about that box in the front of the page, talking about the surrender charge, the cash value, the accumulation value, the market value adjustment. Here's the breakdown of the definitions of each one of them. Some of the better annuity companies will put these definitions out there for you to help you understand it. That's why I chose this statement here. So it's pretty easy to understand. So,
okay.
One more section that you'll see on almost every indexed annuity is going back to the account crediting information. Remember, we talked about the fixed account, the 1 year point to point, and the 1 year, the caps. Okay. This is how they're credited. And you want to see how this works. So fixed account, the credited rate, the interest on this account at the time was 2.6%. Okay, right. Not a bad return, right? Okay, the cap on 1 year point to point in this product was 5%. And the 1 year monthly cap on this one was 1.85 monthly, and the client had earned 11.98%. This is why you want to go and look at the different allocations.
Right.
And hopefully your advisor's doing this. I've looked at so many indexed annuities, Michelle, that the advisors were not, they just stuck them in a fixed account. Yeah. Well, why would you stick a consumer into a 10-year fixed annuity, indexed annuity, when a 5-year MIGA could have done the same thing?
Exactly.
Except for a paycheck. So
anyway. So this is so this is something you can reallocate.
Every 12 months.
Every 12 months. So you can reallocate. So for example, if you were heavier in the fixed account rather than like the monthly cap, what have you, you can move these, or you can move things around. Okay. Got it.
And think about this. Let's look at that too, because remember we talked about the indexes before in several of our other annuity videos, and we'll drop them down below here. But this 1 year point to point cap, Michelle, remember you're in an indexed annuity, you can earn up to the cap that's declared in that index, right? Well, look what happened here. The index change for the last 12 months was how much?
30.62.
30%. What did you get? Your cap.
Right.
There's the trade-off for an indexed annuity. This is a perfect example. Look, you have none of the downside risk, but you give up some of the upside. How much did this client give up on that? Was it $100,000 account? They gave up roughly $25,000 in interest. Yeah, if they would have been in the actual.
But had things not been so well, had gone so well, right? There's that you're
that's the trade-off. And people are willing to make that trade. A 5% return is not a bad return. So anyways, now this is how, anytime you see a monthly cap, whether it be a monthly point to point, whatever it may be, annual cap, monthly average or whatever, they'll do a breakdown here of showing you how this actually works. So here's the 1 year monthly cap, great detail of how they credited the interest, right? Mm-hmm. So this was the S&P 500. So the beginning index was 35.85, ending was 36.63. That month, the index was up 2.18%. Well, back up here to the cap, Michelle, your cap is 1.85 up here. That's the maximum you're going to get, even though it was up higher. Sure. The next month was up 3.9. You still got the cap. 3.2, you got the cap. So you can see that we could have earned a lot more being in the index, but that's the trade-off. Right. 0.21, you got basically the cap. So 5.02 again, 1.85. But look at this.
Negative.
Negative 0.7. Well, what'd you get? Also a negative 0.7. This is why you got to be very careful on an indexed annuity using a monthly cap, because here's the scenario. We see these 0.77 here. You got the 1.85, the cap, negative 2.3, negative 2.3. You got that, right? And then they average them all up for a 12-month period. Okay. Now this client did great. 11.98% is nothing to sneeze at, especially for the amount of money they had in that section. So they made a great return this year. But let's say it's 2022 and the market is very volatile and we're down from where we were last year. Let's say you had 11 great months where you got the cap every single month. Okay. Sure. The cap is the upside cap. What do you think the downside cap is?
The downside cap.
There is none.
There is none. So
that means if we drop 15% in 1 month, you just wiped out 11 months of all your gains here because it gets calculated in the average.
I get it.
Very, very careful in volatile markets.
This is with the monthly cap.
Right. So like right now, here's me right now. Clients coming in, okay, we've already, let's say the market's down 25% right now. What do? I would look at fixed, because the fixed interest rates are up much higher now. And I would also look at going into a different index. Now look at this here. You'll always see the renewal information. So this brings up our next section here. Fixed account is still 2.6%. Okay. That's a nice return in a very volatile market.
Right.
We've already dropped 25%, right? Okay. So do we have a good chance of maybe hitting the 5% cap the next 12 months? I would think so, right? This is what an advisor should do. Go through these, understand what the market is. Don't be writing and selling indexed annuities consumers without understanding what the actual indexes that they track are. So I'm happy with that. So for me right now, we're very volatile. I don't want this monthly cap to move up and down, up and down, up and down like it did. But even though we had a nice return last year, I would go in 50% split in the fixed account, 50% in the point-to-point. And I'd be happy with that.
In a volatile market, you're looking to up the fixed because of, yes, I get it. Okay.
So, and that's what you should do each year. And here's some different different indexes here that I'm not a big fan of. I just don't use them. Look, I track the S&P 500. I like it. It's simple, easy to understand. So,
okay.
But that's right here. These 3 pages is a nice, simple indexed annuity to understand. So
the next time, if you have like an IRA, if you have an annuity and I have like an IRA annuity, I always get my statement. Hey, it's time to reallocate, right? And instead of just doing whatever the person on the other, your advisor tells you, get this out, read it, and ask questions.
Yes, it's that simple. It's that simple.
Why am I in this? And why do you suggest this? And go from there. All right. This has been awesome, Brian. Really appreciate it. Thank you so much. If you like the content of this video, hit that like button. Don't forget to subscribe. Please hit that notification bell so you never miss another video from us. Thanks, Brian, and thanks everybody who watched. Until next time, see you soon.
Thanks, everyone. Hope this helps.